Your phone's about to die. It's on yellow.
Okay. So moving along. Uh, Hello students, welcome to my class. This is Professor Vicente Saga, and this is part 3 of chapter 2 presentation, chapter 2 recording business transactions. This is where we left off. In part 2 we talked about the debit and credit rules extensively. Okay, now let's take a look at the application of the debit and credit rules. Now we are going to use the T account as a basis in demonstrating the debit and credit rules and in figuring out the balance of an account. Okay, so let's take a look at what we have here. Here is a cash account. As you can see, we said that an increase in cash account or an increase in cash will debit the cash account. So here we have $30,000 increase in cash account. Here we have $20,000 decrease, $5,500 increase, and $3,200 decrease. So the question is, what is the balance of cash account? So we have two increases, totaling $35,500. We have two decreases, totaling $23,200. The difference between both is $12,300. So the balance of this account is placed on the side with the larger figure. So 35,500, 23,200, obviously 35,500 is larger, and that is debit, so we have it on the debit side. So we said that the normal balance of an account is shown on the side with the larger figure, and that larger number of figure is usually on the increase side of the account. So moving along, let's take a look at objective 3, recording transaction in a journal and post journal entries to the ledger. Recall we indicated that in accounting we have different accounting records or books that we use to record the business transactions. And the first book of original entry is called the journal. It's very important for you to know that there's a journal. When I say the first book of original entry, meaning every transaction has to be recorded first of all in the journal before we record those transactions in other types of accounting records or book. And the second one is the ledger. So moving along, how do you record transactions? First of all, you need a source document. An example, some people call it business document or source document, meaning your receipt, your invoice, so on and so forth. Just think about when you go to the bank and you deposit $500 cash, you don't just walk away, the bank will give you a receipt. And that receipt is called source document. So we use source document as a basis in recording transactions. In other words, we don't record transactions from the top of our head. We have to use a source document or a business document. So this diagram demonstrates how this is being played out. So the transaction happens, you have a source document, then you analyze the transaction. What does that mean? You think about the impact of the transaction on different accounts. Which account is going to be increased and decreased, and then ultimately you record the transaction. Now, moving along, journalizing and posting transactions. So here's a typo here. Here is journalizing and posting transaction. What does that mean? Again, like I said, in accounting we have a lot of terminology. Instead of accountant to say record a transaction in a journal, you know, because an accountant will give you a source document and say record a transaction in the journal, but rather sometimes we say journalize this transaction. Journalize and record a transaction in the journal are the same thing. So like we said, the journal is the first book of original entry. Now, after recording the transaction in the journal, then we have to transfer it to the ledger. We call that posting. So we record the transaction in one accounting record, we transfer the information to another accounting record. When we do that with self-posting, why are we doing that? We are going to find out in a minute. So moving along, let's take a look at the first transaction. Here on November 1st, the company received $30,000 cash from the owner. So the company received cash. That means the company cash went up. Then the company has to recognize the fact that somebody contributed the money into the company. So think about what happened. What happened? Cash went up. What is cash? Cash is an asset. An increase in an asset is what? We debit that particular asset account. In this case, cash account. So cash account goes up, so we debit it. Then look at what happened. Common stock. Whenever the owner of the company invests money into the company, we keep track of it in an account called what? Common stock. So we credit. Look at this. You need to count this. This $30,000 contribution by the owner result in two accounts being increased. Cash account of the company went up, the owner's investment also went up. So even though two accounts went up, we still have our debit and credit, because we need to establish this part right now. After recording transaction, the total debit and total credit that we record into different accounts has to be the same. So here we have debit of 30,000, we have credit of 30,000. So two accounts went up, but we still have our debit and credit. So what is that saying? That simply means, in contrary to a lot of misconception by a lot of students, they get this easily confused. They said debit is increased, credit is decreased. That is not true. Debit sometimes is increased, sometimes debit is decreased. Same thing with credit. Depends on the account that you are talking about. As you can see here, these three types of accounts, debit is increased, while credit is decreased. For these three types of accounts, the opposite is the case. So moving along, let's take a look at what happened. Here is a fraction of a page. Here is a fraction of a page of a journal. So in real life, you are going to see a journal, a big book like this, could be a loosely binder or whatever. Now, each page will be, every page will be designed accordingly. So this is a fraction of a page. Look at how it is laid out. We have the date, we have the accounts and explanation, we have the debit, we have the credit. In this case, we always write the debit first. So we debit cash for 30,000 and we credit common stock for $30,000. Moving along, after recording the transaction in the journal, this is the journal, look at, we now transfer it to the ledger. Remember, look at this T account. Remember, I told you that for education purposes, we use T account as a matter of convenience, because in real life, we actually have a real book for a ledger. So we transfer this $30,000 into cash account, and we transfer this $30,000 into common stock account. So the question I want to ask you is, why are we transferring the information from the journal to the ledger? The reason is, at the end of the day, we need to be able to tell the balance of each account, and to do that, we have to post all these transactions from journal to ledger. We are going to talk more about that eventually, and you are going to see the beauty or the benefit of posting or transferring information from journal to the ledger. Now, moving along, here is transaction 2. We purchase a piece of land. Land is debited for 20,000. Land is an asset. Cash is credited. So two types of assets are imparted. One asset goes up, one asset goes down. Then of course, here we have a brief explanation of what happened, or the brief explanation of the transaction. So look at part transaction 3. We purchase office supplies. Okay, office supplies is an asset. An asset goes up, so we debit office supplies for 500. We purchase this office supplies on account, on credit. We didn't pay cash, so we have to credit what? Accounts payable for 500. That's an obligation. So an accounts payable is a liability. Accounts payable goes up, we credit. Now, let's take a look at this. Here, we render $5,000 worth of services on cash. So we received $500 cash from customers. What is cash? Cash is an asset. An asset goes up. Cash goes up. So what do? We debit cash and we credit service revenue for $5,500. Moving along, earning of service on account. Here we provided $3,000 worth of services to customers on account. The customer did not pay us. So if a customer doesn't pay us and we have done the work, we need to keep track of it. Which account do we use to keep track of such an event? We call it what? Accounts receivable. So what is accounts receivable? Receivable. Anything receivable is an asset. We are going to receive it in the future. So we debit accounts receivable for $3,000 and we credit sales revenue for $3,000. Now, of course, revenue, when revenue goes up, we credit. So in this case, we provided additional services, so that results in increase in revenue. Let's take a look at transaction 6, payment of expenses with cash. Of course, as you know, we have to spend money to make money. So expenses are the cost of operating a company. So here we pay $3,200 in cash. What happens to cash? Cash goes down. A decrease in cash, cash is an asset. What do? We credit. So we credit cash for $3,200. Here we have expenses, additional expenses. So an expense goes up, we debit. So the two expense accounts are debited. Moving along, transaction 7, payment on account, accounts payable. Remember, we owe somebody because we bought supplies on account. Now we are paying $300 of what we owe. So if we pay, what happens to cash? Cash goes down. A decrease in asset, because cash is an asset. What do? We credit. So cash is credited. Now, an obligation, we don't owe as much money as we owe, because we just pay off some of our obligation. So a decrease in obligation or liability is debit, so we debit. So moving along, let's take a look at transaction 8, collection on account, accounts receivable. Now, remember somebody owe us, the customer show up to pay us $2,000. Alright? So when we receive the $2,000 from customer, of course our cash goes up. So an increase in an asset, in this case cash, we debit cash. And of course, remember accounts receivable, we are no longer going to receive as much from our customer anymore because they pay off some of their obligations to us. So accounts receivable has to be credited. So let's take a look at the transaction 9, payment of cash dividend. Remember now that part of the profit that we made, give it to the owner, we give it a fancy name, we call it what? Dividend, okay? So we said an increase in dividend is what? Debited. So we debit dividend account. Then cash, what do we use to pay the dividend? Cash. So our cash went down. And cash is an asset. When an asset goes down, what do? We credit. So we credit cash accordingly. Now, transaction 10, prepaid expenses. I explained this to you in part 1. What does that mean? That means we pay our expenses ahead of time. In such circumstance, it's an asset until we use it up. So we debit prepaid rent. We pay rent ahead of time for $3,000 for 3 months, and we credit cash for $3,000 because that was a decrease to cash. Transaction 11, payment of expense with cash. Here we pay additional expense. Cash goes down, we credit. Expense goes up, we debit. And then transaction 12, purchase of building with notes payable. What are we talking about here? We purchase building, so we have more property, so that increase. So building is an asset, but we did not pay. We promised to pay by writing a promissory note. So of course, that increases our obligation. An increase in a liability is credit. So we credit note payable for $60,000. Now, transaction 13, stockholders' contribution. So the owner of the company contributed furniture as an investment instead of cash. So the company has more furniture, and furniture is an asset. So that increased furniture by $18,000. Common stock or the owner's investment is increased by $18,000. So accrued liability here, So we are going to cut off right here in transaction 13 and take it from here in part 4, and part 4 will be the last part.